Hello traders, this is Mark Keyworth from flipsidetraders.com, and I just wanted to get back to you guys. We posted this rotational graph and we posted why we're laddering in short, and Twitter does provide some room for explanation, but I wanted to provide a little more comprehensive view of this strategy so that it may help you in the future. So a couple of disclaimers. Number one, this is all about education. This is not trading advice. Please don't consider it as such. Even though I am from flipsidetraders.com, I am not here to sell you anything. I just do have an LLC because I do have a small family office that we keep going. I'm here to join the conversation and help you, and hopefully you guys can help me as well. Another key point is I did not develop this rotational graph. This was developed by the @real Brian Watt. I definitely want to give him the attribution for coming up with this genesis. He has his own application of this, and he does very well with it. I encourage you to listen to him as well. Take potentially hopefully some nuggets here as well as what he says, and inculcate that and synthesize a strategy of your own that fits your trading style. I also want to let you know is I do not position trade futures. I use the futures as a 24-hour, I think the richest price indicator available, and make it use it as a decision index, and then I take advantage of what I see from a price action using options. And lastly, no strategy is foolproof. It's not always going to work. I don't know if the shorts is going to work here, but we shall soon see. And also, none of these strategies and my strategies will not get you in the exact top or the exact bottom, but we do want to get you into the meat of it such that hopefully people can make money from it. Okay, so without further ado, let's jump into the details. Sorry about this. Okay, here is the rotation graph. For some reason, I don't have a print here on the price bars. I'll have to look into that. But let's go forward. So the first thing that triggered the short was when you get in between a 3 and 5% growth from your last significant pivot, which was here, and we have that. We're at 4%. That's kind of my initial trigger. What I've done is I've added Fibonacci's to this to provide me kind of a second trigger as far as extensions. And basically what I have here is I look at this Fibonacci from this point, and I'll show you why I chose this point in a second. And we'll add the drawing as we did in the Twitter post. And you can see that we're at this key, 1.27 extension. The other one for me is the 168. And so now I have kind of two, if you will, should we say, extensions that are telling me that we may be a little bit overdrawn. It does not mean that the market is going to collapse, but we may be able to take advantage of a healthy pullback here. So from the Fibonacci standpoint, it does have a history. Someone was asking me about that. If you look here and we take a look at and draw this Fibonacci again from this high to this low, you can see at the 1.27 became very clear, and this is why this 1.27 at this point at 43.69 is why I drew it for this latest, should we say, leg up and down. It's because I just had this confluence. It just seems to make a lot of sense instead of drawing it from this high at around this 43.80 range. And then lastly, the 1618 worked very well here on this drawing based upon this high and this low. So basically, if we had the drawing from here, from that high, to this low, you can see the 168 brought another key. So that being said, right now I have kind of two reasons to go short, and now also I have a third. And that third, let me get rid of all this junk, has to do with the overall breadth of the market. So if we take a look at the broader breadth, and this is the New York Stock Exchange, this is the advanced declines, you can see that overall that the S&P 500 is still moving up in higher high, higher lows. And basically, right now we're kind of at the all-time highs. We touched that 44.08 level, on Friday. But you can see here, in the broader index, right, the broader stock market itself, we're definitely now getting this divergence, right? We're starting to pull back with lower lows and lower highs, even though the market is still moving forward. If we take a look at that and we say, okay, we look at growth, because growth in the NASDAQ really seems to be driving this, and we take a look here, we look at the NASDAQ, you can see that this advanced decline, again, we have lower highs, lower lows, we're down below the key moving average here. And this suggests that we're single threaded and that the market is showing some overall structural weakness, and we may be ready to take advantage of that structural weakness. Now, I took advantage of that structural weakness via a credit spread to enter, and I did that because I also want to look at the other side of the trade. Okay, what's going on still from the bullish perspective? So let's take a look at that from a number of different reasons, and we'll go back to a different chart. And so right now we're looking at the ES, and we know that from overall, we think that growth has been driving us forward. And let's go ahead and where are we going to pull that up? Okay, let's pull that up from the sector summary. So if you look at what's going on, this is in the past week, you can see that communications, community discretionary, and technology and healthcare are all in the growth sectors. All right, when we think about FANG, you think about things that are distributed across these sectors. XLK right now makes up about 27% of the S&P 500. From the consumer discretionary, right, we're looking at things, especially like Amazon, kind of driving it forward. XLC, if you look at this, is on the internet side of this piece, right? This is Google and your Facebooks. So even though the classifications may be different, the FANG stocks and the FANG sectors are really pushing this. That growth is really moving. And we could also take a look at growth from this perspective as well. This graph here shows growth divided by value. And you can see right now that growth is overall outperforming value. And I'm sorry, value's in the numerator. I got it mixed up. My bad. So basically, as growth moves forward, this line is going to go ahead and decrease, right? Larger the denominator, smaller the numerator, and we have that moving down as well. The other thing I want to take a look at real quick is interest rates, because from the growth side, interest rates, and we've seen it in the past, growth stocks have been very, very sensitive to this interest rates, and we have this trend: lower highs, lower lows, and we're down below the 200. So all those things, right, from a growth perspective, are saying, you know what, we may have a little bit more to go, so I don't want to go all in. Now, there's one more thing I want to take a look at, and that's to kind of really show you the other side of this, and that's price action. And I will look at price action, right? We've kind of established now that the FANG stocks are kind of this single-threaded piece moving forward, kind of moving the market. If we take a look at Amazon, we go back to the last earnings session, right? We can see that we had this, should we say, growth and basically price advance into earnings. But once we had earnings, right, on 4/27, or here it is back here, on 4/28, we had a pullback. Same thing, we look at Google, right? That's in the communication side of the XLC, right? We have a pullback. We go ahead and take a look at Microsoft, right? Straight tech, if you will. Again, we have the run up into earnings, and again, the pullback. So next week is this earnings trade. So we have a possibility that, this growth phenomenon that we're seeing as far as driving the market higher could keep going from the next week. And as a matter of fact, if we look at the ES, right, and we know that all the FANG stocks, from the last earnings session happened in that 426 kind of to that 730 piece. And so we look at here's that 426, 427. We had a little bounce, and then you can see it bounced up, but we had this divergence here, right, from a momentum standpoint. It drove us lower. And that happened, basically here in kind of the 7th, 8th of August. So it was a couple days out. So the culmination of all this is saying, yeah, we may go short. I want to take advantage of going short, but I'm not going to go all in. I want to leave some breathing room. I want to do that using a call spread. So using a call spread the question is, how far out do we go? And what short strike do we do in order to get our toe in the water? So we're participating emotionally, but we're still giving ourselves some breathing room. So let's go back and take a look at this price history, and you can see a couple different things. This channel line has been very, very effective from the overall highs and overall tops in kind of confining price. In addition, what we see here in these dotted lines, this is the first standard deviation of the Keltner channel, second and a third. And the third standard deviation, as you know, standard deviations, let's see, the first one is about 68%, the second one is about 95%, and and the third one gets you into like the 98, 99 percentile. And you can see the working action of both the trend line and the Kelter channel have really served as kind of a cap, if you will, or analyst a bounce and a key point of resistance of the ES. So when I take a look at this and I kind of project going forward, let's make this bigger again, and we'll go ahead and pull this down. And we say, okay, if we go out to about 8.9, kind of, 8.10, we can see that this, if we kind of extrapolate this going forward, that the Keltner channel will be paralleling right up here, and then we get to this point. So anything above 4,500 is a good shot, but what I like to do is take a little bit more, should we say, cushion. And so what I look at is, okay, 20 days out, so like the August 13th expiration on the XPX, I like to do what I call a 10 by 10. So that'll be 10 wide. So basically the short strike will be 10 wide, and I try to use like the delta 10, which again gives me kind of roughly a 90% probability standpoint of, that short strike being out of the money. And we go basically 10 wide, so 45.50 to 45.60, and we're looking for about 50 cents, and that's a good way to participate. And obviously that will go to zero at some point in time. We take advantage of theta going forward. So that's the way I kind of look at it. Now it provides me also a finite risk versus going in with a future. Going forward, I know that my risk is about, if I'm 5 contracts, if I'm trading, at that level, is about, 5K. And if I go 10 contracts, then it goes to 10K, etc. It ratchets up. And I just feel really comfortable, with that kind of a, toe holder in place. If you do not like, should we say, options and credit spreads, then I would say, use the SPY. If you're not going to use the MES, the SPY kind of in that, I would probably use the monthlies. I would probably take about, 2 strikes out of the money. I think that's the last time I looked. They're running about 350, a contract, and I would probably, put down 2. So it's $700, of overall risk. But now, I know that I'm in going forward. So the next question, so that hopefully that provides you, number one, a way to get in. My next ladder, of course, would be at the 1618 extension. I'll go ahead and show you that. We'll go back. We'll flip right, back here. Right, the 168 extension. Let's see if I go back from here. I'll add that for you. So my next big ladder is would be here in that kind of 44.50 area. In addition, hold on a second. In addition, I'm also kind of looking for a trigger. So if I look back at the 30-minute chart, you can see here I'm starting to see this. The 5 is starting to cross, the 13. That tells me that I could start, maybe adding some puts in this beginning on Monday. But I wouldn't go too heavy. Because why? Because basically look at the last 4 or 5 days of price action. We have not, shown any preponderance to test the previous day's low or close below the previous day's low. So again, this is kind of like my first trigger. I would start adding some puts if this stays, if we have that cross here, starting Monday morning. I already have the credit spread, so that'd be good. And then finally, what is the target? And so, the target is basically, if you take a look at what's been happening, at least the last 2 or 3 times, has been the 50 EMA. Sounds like a good spot for a target. Number one, you can see that price has rejected it here, 1, 2, 3 times. But also we can take a look at symmetry. Again, I go back to the fibs a little bit, and if I look here and I look at, from 42.59, and I take a look at that dropping down to, 41.24, and I'm going to project that to here, and you're going to see that it's almost exactly 100%. And so we take the extension from this high to low, we then project it, to this high, and you can see that right here we had another confluence. So again, I'm really trying to stress the point where I'm not looking at just one indicator or one thing. I'm looking at kind of multiple ideas of where a stopping point may be, or even a trigger may be. And also you can see, if you really take a look at this and draw across here as well, we extend kind of this line, you can see that there's some definitely decent price action. Here resistance becomes support, and so now we have kind of three different things, if you will, that would go ahead and set us up for what could be a potential target. Definitely take some profits at that point, and or tighten stops. Hopefully you leave a runner and go from there. Well, guys, I hope that extended explanation helped you. I look forward to interacting with you in the future, and we'll catch you on the flip side. Thanks. Talk to you soon.